Welcome to American Money, the channel dedicated to finding the smartest ways to grow your wealth. Today, we're talking about a region that, despite its immense potential, is currently among the cheapest and most undervalued places on Earth to invest: Latin America. American Money is for educational and entertainment purposes only. We are not licensed financial advisors. Investing involves risk, and you should always conduct your own research or consult a certified professional before making any investment decisions. Take a look at the imagery on the screen. On the left, we see the towering heights of the modern skyscraper, representing the U.S. markets which have been pushing against historical ceilings and record-high valuations. On the right, we see the bedrock, raw, foundational, and largely untapped. This is the central thesis of our discussion today. While the North is reaching its limit, a massive deep value opportunity has emerged in the South. As of January 2026, the global investment landscape has shifted. For years, capital flowed almost exclusively into U.S. tech and domestic equities. But as those markets become increasingly expensive and crowded, savvy investors are looking for where the next cycle of growth will begin. We're calling this the Latin America Awakening. When we talk about deep value, we aren't just talking about low prices. We're talking about a fundamental disconnect between the intrinsic worth of these economies, their resources, their burgeoning middle class and their digital transformation, and their current market pricing. Latin America is no longer just a speculative play. It is the strategic bedrock for the 2026 landscape. We are currently witnessing a historic divergence between these two worlds. Look at the Shiller CAPE ratio. For the S&P 500, we are currently trading in the 98th percentile of all historical valuations. We are at levels only seen twice before in 150 years, the 1929 crash and the 1999 dot-com bubble. Historically, when valuations are this stretched, the forward 10-year returns have averaged just 0% to 3%. Now, look at the South. While the North is expensive and crowded, Latin America represents a mean reversion play. In 2025 alone, Latin American markets gained over 50%, significantly outperforming the S&P 500 and even major AI superstars. Despite this surge, valuations in markets like Brazil and Chile remain at a discount compared to their long-term historical averages. This is what we call an asymmetric opportunity, where the potential upside far outweighs the downside risk. By shifting focus to this bedrock, we are moving away from a market with high volatility and low expected returns into a region that is finally awakening after a decade of underperformance. After a decade of being overlooked, the region is finally moving back toward its fundamental value. While the world was focused on AI and big tech, the real growth was happening right under our noses in the emerging markets of the South. If you feel like the current market environment is unprecedented, you're right, but it's not without historical parallels. As we sit here in January 2026, the S&P 500 has just hit a series of new record highs, pushing the index toward the 7,000-point mark. But beneath that surface of all-time highs, a major warning signal is flashing. Look at the Shiller CAPE ratio, our most reliable gauge of long-term value. It is now surged to 39.85. In the last 150 years of market history, we have only seen valuations this extreme twice, right before the 1929 Great Depression and at the absolute peak of the dot-com bubble in 2000. When the CAPE ratio crosses the 35 mark, it places the market in the 95th percentile of all historical data. Historically, this isn't just a sign of being expensive, it's a predictor of outcomes. At these levels, real returns over the next decade have typically fallen well below the long-term average, often averaging just 0% to 3%. The market is essentially running on borrowed time, priced for absolute perfection with a razor-thin margin for error. This is the ceiling we talked about. But while the U.S. is struggling with these perfect expectations, the bedrock of Latin America is just beginning to react. Here is why that rotation is finally gaining momentum.
To understand what's happening between the US and Latin America right now, you have to understand the rubber band effect. In finance, this is a form of mean reversion. Think of the market as a rubber band. The further it's stretched away from its historical average, the more energy it builds up to snap back. On one side, we have the US markets. This rubber band has been stretched to its absolute limit. It's overbought, expensive, and fighting that historical ceiling we talked about. When a market is this overextended, the tension becomes unsustainable. History shows us that these extremes don't last. They eventually snap back toward the mean. Now, look at Latin America. For years, this rubber band was stretched in the opposite direction. The region was oversold, underfunded, and trading at a massive discount compared to the rest of the world. But in 2025, that tension finally broke. The rubber band began to snap back, releasing a decade's worth of built-up value in a single year. This is the awakening. We aren't just seeing a lucky streak, we are seeing a structural mean reversion, a return to balance. And because the gap was so large to begin with, the momentum behind this snapback has enough energy to drive the region's markets for years to come. To move from theory to proof, we have to look at the math. In the world of institutional investing, we use something called a Z-score. It's a statistical measurement that tells us exactly how far an asset has strayed from its historical average. Think of it as a valuation thermometer. As of early 2026, the divergence is staggering. While U.S. markets have been pushing into territory 2 standard deviations above the mean, Latin American equities have spent the last few years at a Z-score of -2.1. In plain English, that means Latin America has been trading at a discount so extreme it only occurs about 2% of the time. This is the statistical smoking gun. When you see a Z-score this low, you aren't just looking at a cheap market. You're looking at a mean reversion trigger. History shows that when the rubber band snaps back from these levels, the ensuing rally isn't just a few percentage points, it's a structural re-rating of the entire region. We already saw the first stage of this in 2025. The Franklin FTSE Latin America ETF, or FLLA, surged by over 51% as the market began to wake up to this valuation gap. But even after that massive run, the awakening is still in its early innings because the bedrock, that fundamental value, remains incredibly deep. If you want to know which direction a market is likely to move, look at what's already baked into the price. In January 2026, the S&P 500 is trading at a forward price-to-earnings, or PE, ratio of 22.4x and the regular PE of 28.6x. That is a price for perfection valuation. A 22.4x multiple means investors are paying a premium well above the 10-year average of 18.8x. At these levels, there is zero room for error. If corporate earnings growth misses the double-digit marks analysts are projecting for 2026, or if inflation remains sticky near 3%, the only way for that ceiling to move is down. Now, look at the contrast in Latin America. While the U.S. is pushing 28x earnings and 22x forward earnings, major funds like FLLA are trading at a staggering discount, with a PE ratio of just 9x. This is what we call priced for disaster. The market has spent years pricing these economies as if they would never grow again. This 125% valuation gap is one of the widest we've seen in the modern era. When you buy at 9x earnings, you aren't just buying value, you're buying a massive margin of safety. As the region continues its awakening, simply returning to a normal valuation could trigger a windfall even without explosive growth. The bedrock isn't just solid, it's incredibly cheap. If the standard PE ratio shows us a snapshot, the Shiller CAPE ratio gives us the full movie. By averaging the last 10 years of inflation-adjusted earnings, we can see past the temporary noise of the business cycle to find the true structural value of a market. In the US, that movie is currently a thriller. The Shiller CAPE for the S&P 500 has surged to 39.8,
a level 135% above its historical average. Historically, valuations this high have only ever been seen twice, in 1929 and 2000. In both cases, what followed was a decade of stagnant or negative real returns. But look at the deep value in the South. While the US is pushing 40, the Latin America CAPE ratio is sitting at roughly 14. This represents a 65% discount compared to US equities. We aren't just looking at a minor price difference, we are looking at two completely different economic realities. The math is simple. Lower starting valuations are the single strongest predictor of higher long-term returns. In 2025, we saw the awakening begin as investors finally noticed this gap. With a 65% discount still on the table, the bedrock of Latin America isn't just an alternative. It is the most compelling structural trade of the decade. Now, seasoned investors will look at these 9x earnings and 65% discounts and ask the million-dollar question: is this a value trap? Usually when a market is this cheap, it's because it's broken, priced for a recession or a structural collapse. But here is a reality. Latin America's economic engine is far from stalled. Unlike a recessionary environment which would justify bottom-barrel prices, the region's economic pulse is steady and active. We aren't looking at a collapse, we're looking at an expansion that the market hasn't priced in yet. According to the latest 2026 projections from ECLAC, the region is expected to see a GDP growth of 2.3%. While that might seem modest compared to high-growth tech sectors, you have to remember the context. In the world of value investing, you are acquiring assets at disaster-level prices, but you're receiving moderate expansion results. When you find a market that is priced for negative growth but delivering positive GDP expansion, you found a massive disconnect. This is the awakening in action. The region isn't broken, it's just profoundly mispriced. And as 2026 progresses, the gap between these low valuations and the actual economic reality is where the greatest gains will be made. By now, the data is clear. The South is providing a bedrock of value that the North simply cannot match in 2026. But for most investors, the challenge isn't seeing the opportunity, it's executing the trade efficiently. This is where the Franklin FTSE Latin America ETF, or FLLA, comes into play. In a region where management fees can often eat away at your returns, FLLA stands out for its extreme efficiency. It carries an expense ratio of just 0.19%. To put that in perspective, that is roughly 67% lower than the average fund in the Latin America category. You are keeping more of your capital at work in the bedrock. FLLA doesn't just give you one country. It provides broad physical exposure to 134 large and mid-cap companies across the region's powerhouses: Brazil, Mexico, Chile, and Colombia. You're holding regional giants like Vale, Itaú Unibanco, and Petrobras. Plus, it offers a substantial 12-month trailing dividend yield close to 6%, providing a strong income stream while you wait for the awakening to fully price in. This isn't about chasing the next tech fad. It's about a disciplined, low-cost allocation to the most undervalued region on the map. With over 50% total returns in 2025, FLLA has already proven the rubber band is snapping back. For those looking to anchor their 2026 portfolio in something solid, this is your entry point. We've looked at the data, the rubber band effect, and the massive valuation gap. But there's one final hurdle every investor faces when moving into emerging markets: the cost of entry. If you choose the wrong vehicle, management fees can quietly strip away your gains before they ever hit your account. Look at the landscape of Latin America ETFs. Legacy competitors like the iShares Latin America 40, ILF, carry an expense ratio of 0.47%. On the surface, it sounds small. But when you compare it to the Franklin FTSE Latin America ETF, FLLA, the difference is night and day. FLLA offers a rock-bottom fee of just 0.19%. That isn't just a minor discount. You are paying 60% less in fees compared to the legacy leaders. In the world of investing, fees are the only thing you can truly control. By choosing the more efficient vehicle, you're ensuring that more of your capital stays anchored in that deep value bedrock we've been discussing. The Latin America awakening is more than just a trend. It's a structural re-rating of an entire continent. While the North continues to push against its historical ceiling, the South is offering a rare asymmetric entry point for the 2026 landscape. Don't let high fees or market complacency keep you from the bedrock. The rotation is here. Is your portfolio ready? In the world of high-growth investing, you're often gambling on future capital gains to see a return. But value investing is different. When you buy into the bedrock of Latin America, you aren't just waiting for the awakening to happen. You're getting paid for your patience. As of January 2026, the trailing dividend yield for this region sits at a massive 6%. To put that in perspective, that is nearly 4 times the current dividend yield of the S&P 500. This is the mathematical result of depressed prices. As valuations drop, the effective yield for new investors surges. This 6% yield provides a vital income buffer. It enhances your total return and acts as a shock absorber against market volatility. While other investors are sweating over daily price swings and overextended tech stocks, you are earning a premium yield just for holding your position while the market slowly revalues the region. This is the definition of a smart money move, acquiring cash-flowing assets at a deep discount. You aren't just speculating on a turnaround. You're building a portfolio that generates significant income from day one, anchored in the most undervalued bedrock on the planet. Now that we've established the massive valuation gap and the efficiency of the vehicle, the final question is, how does this fit into a modern portfolio? In early 2026, we see 2 primary paths for integrating the Latin American bedrock into your strategy. The first path is the conservative anchor. This is a 5% allocation designed as a strategic value tilt. If your portfolio is currently heavy on U.S. tech or growth stocks, this 5% acts as a vital hedge. It provides diversification into an uncorrelated region that is trading at a deep discount, offering stability if that U.S. historical ceiling finally gives way. The second path is for those seeking to maximize the structural turnaround, the aggressive value play. Here, we look at a 25% allocation. This is a high-conviction move designed to capture the full force of the mean reversion gains we've discussed. At 25%, you aren't just hedging, you are positioning your portfolio to be a primary beneficiary of the Great Rotation South. Whether you choose to use it as a 5% anchor or a 25% growth engine, the goal remains the same: moving capital away from priced for perfection and into deep value. It's about being intentional with your risk and ensuring your foundation is built on solid rock, not thin air. We've traveled from the historical ceilings of the North to the deep value bedrock of the South. The narrative for 2026 is now undeniable. We are looking at a tale of 2 markets. On one hand, you have the US, a fantastic growth engine, but one that is currently priced for perfection. On the other hand, you have Latin America, a powerhouse value engine that is priced for recession despite a growing and active economy. By utilizing a low-cost, high-yield vehicle like FLLA, you are essentially stepping out of a crowded, expensive domestic trade and into a region where the statistical odds are heavily skewed in your favor. This is what professional investors call an asymmetric bet, an opportunity where the potential for gain vastly outweighs the risk of the entry price. The Latin America awakening isn't just a possibility, it's a structural shift that is already underway. The data is clear, the vehicle is efficient, and the bedrock is solid. The question is no longer if the rotation will happen, but whether you'll be positioned when the rubber band fully snaps back. If you found this deep dive helpful, make sure to hit the like button and subscribe for more macro analysis as we navigate this 2026 landscape. I'm curious, are you leaning toward the conservative anchor or the aggressive play? Let me know in the comments below. Thanks for watching.